Real estate is how more millionaires are created than any other investment vehicle. Not stocks, not crypto, not businesses. Real estate. And it's not even close. But here's what's crazy. Most people have no idea how rental real estate actually works. They think you need hundreds of thousands of dollars to start. They think it's risky, they think it's complicated, and because of these misconceptions, they miss out on the single best wealth-building tool available. By the end of this video, you'll understand exactly how rental properties generate wealth, the real numbers behind a rental property, and the exact strategy to get started even if you're not rich. This is the education they should have given you in school. Look, I'm not going to sugarcoat this. Real estate isn't passive income, at least not at first. It requires work. It requires learning. It requires dealing with tenants and toilets and maintenance. But here's what makes it worth it. Real estate builds wealth in 4 different ways simultaneously. Stocks give you 1, maybe 2. Real estate gives you 4. And when you understand how these 4 wealth-building mechanisms work together, you'll see why millionaires are obsessed with real estate. Most people think rental properties are about collecting rent checks. That's part of it. But that's not where the real money is made. Stick with me for the next 12 minutes because I'm going to break down the real numbers, the real strategies, and the real math that most gurus won't tell you because they're trying to sell you courses instead of giving you the truth. 1. The 4 ways real estate builds wealth. Let me start by explaining why real estate is so powerful. When you buy a rental property, you're getting 4 separate wealth-building mechanisms working for you at the same time. This is critical to understand because most people only see 1 or 2 of these. Wealth builder. 1. Cash flow. This is the obvious one. You buy a property, you rent it out. The rent covers your mortgage, property taxes, insurance, and maintenance. Whatever's left over is your cash flow. If the rent is $2,000 a month and your total expenses are $1,700, you're making $300 in cash flow. That's passive income. Money coming in every month whether you work or not. Now, $300 a month doesn't sound life-changing, but here's the thing. That's per property. You have 5 properties each, cash flowing $300 a month, that's $1,500 a month, $18,000 a year. That's a significant income stream. And unlike a job, this income doesn't require 40 hours a week. Once the property is set up and rented, it's mostly automated. Wealth builder. 2. Appreciation. Real estate historically appreciates at about 3 to 4% annually, sometimes more in hot markets, sometimes less. But over time, property values go up. Why? Because land is finite and population grows. There's always more demand for housing. So that $300,000 property you buy today, in 10 years at 3% annual appreciation, it's worth about $403,000. You made $103,000 just by owning it. And here's the beautiful part. You're not doing anything to make this happen. The market is doing the work for you. You're benefiting from economic growth, inflation, and demand. This is wealth you're building without any additional effort beyond maintaining the property. Wealth builder. 3. Loan paydown. This is the one most people miss, and it's massive. When you buy a rental property, you typically put down 20 to 25% and finance the rest. Your tenant's rent is paying your mortgage every month, which means your tenant is buying the property for you. Every single month, a portion of that mortgage payment goes toward the principal, reducing your loan balance and increasing your equity. Let's run the numbers. You buy a $300,000 property. You put down $60,000. 20%. You finance $240,000 at 5% interest over 30 years. Your mortgage payment is about $1,289 a month. In the first year, about $5,000 of that goes toward principal. Your tenant paid that. You just built $5,000 in equity without using your own money. In year 10, you're paying down about $7,500 a year in principal. Year 20, over $10,000 a year. By year 30, the property is completely paid off. You own a $400,000 asset that your tenants bought for you. This is forced savings. This is wealth building on autopilot. Wealth builder. 4. Tax benefits. Real estate has insane tax advantages that most people don't know about. First, you can deduct mortgage interest, property taxes, insurance, maintenance, property management fees, and pretty much every expense related to the property. This reduces your taxable income. But here's the big one: depreciation. The IRS lets you depreciate your property over 27.5 years for residential real estate. Even though your property is actually appreciating in value, you get to write off the depreciation as a loss on your taxes. This often wipes out your cash flow on paper, meaning you pay little to no taxes on your rental income. So you're making $300 a month in cash flow, but on your tax return, you're showing a loss because of depreciation. You're building wealth tax-free. This is completely legal, and it's how real estate investors pay way less in taxes than regular employees. And when you eventually sell, you can do a 1031 exchange to defer capital gains taxes indefinitely by rolling your profit into another property. These four mechanisms working together is why real estate creates so much wealth. You're getting cash flow, appreciation, equity buildup, and tax benefits all at the same time. No other investment gives you this combination. 2. The real numbers. Now, let's talk about what a real rental property actually looks like financially, because most people have no idea what the numbers are. They hear about real estate and think you need to be rich to start, or they think every property makes you rich overnight. Both are wrong. Let me show you a realistic example. Let's say you buy a single-family home for $300,000. You put down 20%, that's $60,000. Your loan is $240,000 at 5% interest over 30 years. Here's what your monthly expenses look like. Mortgage, $1,289. Property taxes, about $300 depending on location. Insurance, $150. HOA fees, if applicable, maybe $100. Property management if you hire someone, 10% of rent, so let's say $200. Maintenance reserve, you should set aside 1% of property value annually, so about $250 a month. Vacancy reserve, assume 10% vacancy, so another $200 a month. Total monthly expenses, about $2,389. Now, what's the rent? For a $300,000 property, you're probably renting it for about $2,400 to $2,600 a month, depending on the market. Let's say $2,500. Your cash flow? $2,500 minus $2,389 equals $111 a month. That's it. That's what most real rental properties cash flow, especially in the beginning, $100 to $300 a month per property. Not life-changing on its own, but remember, that's just one of the four wealth builders. Let's look at your total return. Cash flow, 111 times 12 is $1,332 a year. Appreciation at 3%, $9,000 on a $300,000 property. Principal paydown in year one, about $5,000. Tax savings from depreciation, maybe $2,000 to $3,000 depending on your tax bracket. Total wealth created in year one, roughly $17,000 to $18,000. You invested $60,000 down payment. Your return in year one is about 30%. Show me a savings account or CD that does that. Even the stock market averages 10%. You're getting 3 times that with real estate, and most of it is forced savings and appreciation that you can't screw up by panic selling. Now here's where it gets really interesting. Fast forward 10 years. Your property appreciated to about $403,000 at 3% annually. Your loan balance is down to about $200,000. Your equity is now $203,000. You started with $60,000 in equity. You now have $203,000. That's $143,000 in wealth created, and you're only putting in about $100 a month in cash flow. The rest was built automatically through appreciation and your tenants paying down your mortgage, and your cash flow has increased because rents typically rise with inflation. That $2,500 rent is now probably $3,000 a month, but your mortgage stayed the same at $1,289. So your cash flow went from $100 to about $400 a month. Your income increased while your expenses stayed flat. This is the beauty of fixed-rate mortgages with rental properties. 3. The leverage game. But here's where real estate becomes truly powerful: leverage. This is the secret that separates real estate from almost every other investment. With stocks, if you have $60,000, you can buy $60,000 worth of stocks. Your returns are based on $60,000. With real estate, you take that same $60,000, use it as a 20% down payment, and you control a $300,000 asset. You're getting returns on $300,000, not $60,000. That's 5 times leverage. This is legal, this is normal. This is how real estate works. And here's the crazy part. The bank is giving you $240,000 at 5% interest. Meanwhile, your property is appreciating at 3 to 4%, and you're getting cash flow and tax benefits on top of that. You're making money using someone else's money. The tenant is paying the bank back while you keep all the appreciation, equity buildup, and cash flow. This leverage is why real estate creates millionaires. You can control multiple properties with relatively little of your own money. Someone with $300,000 in cash could buy 5 properties using $60,000 down payments each. Now they're controlling $1.5 million in real estate. They're getting appreciation, cash flow, and equity buildup on $1.5 million, not just $300,000. In 10 years, those 5 properties could be worth $2 million with about $800,000 in equity after accounting for loans paid down, and they're cash flowing maybe $2,000 to $3,000 a month total. That's the power of leverage. You're multiplying your returns by using debt intelligently. Now, leverage is a double-edged sword. If property values crash, you can lose money. If you can't cover the mortgage because you have vacancies, you're in trouble. This is why you need reserves. This is why you need to run the numbers carefully. But used correctly, leverage is the most powerful wealth-building tool available to regular people. 4. How to actually start. So how do you actually get into rental real estate? Let's break down the real steps, not the guru nonsense. Step 1. Save your down payment. You need 20 to 25% down for an investment property. On a $300,000 property, that's $60,000 to $75,000. Sounds like a lot, but it's achievable if you're disciplined. Cut expenses. Increase income. Save aggressively for 2 to 3 years. If you can save $2,000 a month, you'll have $60,000 in about 2.5 years, including some investment return. Or use a house hacking strategy. Buy a small multifamily property as your primary residence with only 3.5 to 5% down using an FHA loan. Live in one unit, rent out the others. The rent covers most or all of your mortgage. You're living for free or cheap while building equity. In a year or two, you move out, turn your primary into a rental, and repeat. This is how people build portfolios with less capital up front. Step 2. Understand your market. Not every market is good for rental properties. You need to understand rent-to-price ratios, vacancy rates, employment trends, and population growth. A good rule of thumb is the 1% rule. Monthly rent should be at least 1% of the purchase price. So a $300,000 property should rent for at least $3,000 a month to cash flow well. Some markets, this is easy. Midwest and South often have better cash flow. Coastal cities often have terrible cash flow but better appreciation. You need to decide what your strategy is. Are you going for cash flow or appreciation? Both is ideal but rare. You also need to understand tenant quality in different neighborhoods. Class A properties in nice areas have stable tenants but lower cash flow. Class C properties in rough areas might cash flow more, but you'll deal with more headaches, vacancies, and potential losses. Most investors target Class B properties as a balance. Step 3. Run the numbers. Obsessively. Most people lose money in real estate because they didn't run the numbers correctly. They underestimated expenses. They overestimated rent. They didn't account for vacancies. You need to be conservative in your estimates. Always assume higher expenses and lower rent than you think. Build in buffers. Use the 50% rule as a starting point. Assume 50% of your rental income will go toward expenses excluding the mortgage. So if rent is $2,000, expect $1,000 to go toward taxes, insurance, maintenance, vacancies, management, and other costs. The other $1,000 needs to cover your mortgage and leave you with cash flow. If the numbers don't work with this rule, the deal probably isn't good. And always have reserves. You should have at least 6 months of mortgage payments saved per property. Things will break. Tenants will leave. You need a cushion, or you'll be forced to sell at the worst possible time. Step 4. Finance smart. Get pre-approved before you start looking. Understand that investment property rates are typically 0.5% higher than primary residence rates. Shop around for lenders. Credit unions often have better rates than big banks. Your credit score matters a lot here. Above 740 is ideal for the best rates. Consider house hacking for your first property to get owner-occupant financing. 3.5% down versus 20% is a huge difference in capital required. Then after a year, move out, rent it, and do it again. This is a legitimate strategy many investors use. Step 5. Property management. You have 2 options: manage yourself or hire a property manager. Managing yourself saves money but costs time. You deal with tenant calls, maintenance issues, lease renewals, and evictions if necessary. Hiring a property manager costs about 10% of monthly rent but removes most of the headache. For your first property, I'd recommend managing yourself for at least a year so you understand the business. Then, once you have multiple properties or want to scale, bring in professional management. The goal is eventually having a portfolio that's truly passive, but you need to learn the ropes first. 5. The risks nobody talks about. Let's talk about what can go wrong, because real estate isn't risk-free. You need to understand the downside before you jump in. Risk 1. Bad tenants. You can screen perfectly and still end up with a tenant who stops paying rent, damages the property, or refuses to leave. Evictions take months and cost thousands in legal fees and lost rent. This is why you need reserves. This is why you need to screen thoroughly. Check credit, income, rental history, criminal background. Don't rent to someone just because they're available. Risk 2. Major repairs. The roof could fail. The HVAC could die, the foundation could crack. These repairs can cost $10,000, $20,000, even $30,000. If you don't have reserves, you're screwed. This is why the maintenance reserve is critical. Most new investors underestimate how expensive property maintenance really is. Risk 3. Market crashes. Real estate values can drop. We saw it in 2008. If you need to sell during a downturn, you could lose money. This is why you need to buy right and plan to hold long term. Real estate should be a minimum 5 to 10 year investment. If you might need the money sooner, don't buy property. Risk 4. Vacancies. Your property will sit empty sometimes. Tenants move out. It takes time to find new ones. During that time, you're covering the full mortgage, taxes, and insurance yourself. This is why the vacancy reserve exists. Plan for 10% vacancy, even in hot markets. Risk 5. Over-leveraging. Some people get excited, buy too many properties too fast, and can't handle the cash flow requirements when multiple things go wrong. Start slow. Make sure one property is stable before buying another. Don't assume everything will always go perfectly. These risks are real, but they're manageable if you're prepared. The people who fail in real estate usually fail because they didn't have reserves, didn't screen tenants, or bought bad deals thinking they could force them to work. 6. The long-term game. Here's what most people miss about real estate. It's not a get-rich-quick scheme. It's a get-rich-for-sure scheme if you're patient. The wealth comes from holding for decades, not flipping for quick profits. Think about it this way. You buy one property at 30 years old. You hold it for 30 years. By the time you're 60, that property is completely paid off. Your original $300,000 property is now worth maybe $700,000 due to appreciation. You own it free and clear. It's cash flowing maybe $3,000 a month because there's no mortgage and rents have doubled. That's $36,000 a year in income from one property bought 3 decades ago. Now imagine you bought one property every 2 to 3 years during your 30s and 40s. By 60, you have 10 properties completely paid off. They're worth $7 million total. They're generating $30,000 a month in cash flow. That's $360,000 a year in passive income. You're financially free. You never have to work again. This is how real estate creates millionaires. But it requires patience. It requires discipline. It requires dealing with the hassles in your 30s and 40s so you can have freedom in your 50s and 60s. Most people aren't willing to do this. They want the result now. But wealth building doesn't work that way. The people who win with real estate are the ones who start early, buy consistently, hold long term, and don't panic during downturns. They understand this is a decades-long game. They're playing chess while everyone else is playing checkers. So here's the bottom line. Rental real estate works because it builds wealth in 4 different ways simultaneously: cash flow, appreciation, loan paydown, and tax benefits. No other investment gives you this combination, but it requires capital, knowledge, and patience. It's not passive at first, it's not easy, it's not risk-free. But if you're willing to learn the game, save the down payment, run the numbers correctly, and hold long-term, real estate can completely change your financial life. It's the proven path to wealth that millionaires have used for generations. The question is, are you willing to do what it takes? Start by educating yourself. Read books, analyze deals in your market, build your down payment savings, connect with real estate investors, learn before you buy. Then, when you're ready, take action. Your first property is the hardest, but once you get that first one, the second is easier, the third is easier, and before you know it, you have a portfolio building wealth while you sleep. Drop a comment and let me know. Are you already investing in real estate? Are you saving for your first property? What's holding you back? Let's talk about it. And if you want more real estate content with actual numbers and strategies, let me know. I'll see you in the next one.